Welcome to our Business Education and Research channel. In today's video, we will present a comprehensive guide on debt mutual funds investment. Today, we are going to explore how these funds work, their benefits, and key strategies for selecting the best debt funds to enhance your investment portfolio. Whether you are a conservative investor or looking for a stable income options, this video will provide you with essential insights to navigate the world of debt mutual funds effectively. Let us try to understand the basic concept of debt mutual funds. Definition and purpose. Debt mutual funds invest in fixed income securities like bonds, government securities, treasury bills, commercial paper, and other debt instruments. They aim to provide investors with stable returns and lower risk compared to equity investments. Suitability for investors. Debt mutual funds are ideal for investors seeking regular income with moderate risk. They are suitable for short to medium term investment horizons and for those looking to balance the equity volatility in their portfolio. For example, the HDFC Corporate Bond Fund invests primarily in high quality corporate bonds, aiming to provide regular income through interest earnings while maintaining a moderate liquidity profile. Now let us try to understand the various types of debt mutual funds. Variety in funds. There are several types of debt mutual funds available in India, including liquid funds, dynamic bond funds, gilt funds, and credit risk funds, each serving different investor needs and market conditions. Choosing the right type. Selecting the right type of debt fund depends on your investment objective, horizon, and risk tolerance. Each fund type has different characteristics in terms of interest rate risk and credit risk. For example, liquid funds like ICICI Prudential Liquid Fund offer a safe option for parking surplus funds with the advantage of quick liquidity and minimal interest rate risk. Now let us try to understand the fund performance of debt mutual funds. Evaluating performance metrics. When evaluating debt funds, look at the credit quality of investments, the fund average maturity, and the yield to maturity (YTM). These factors will help you to understand the potential return and risk associated with the fund. Benchmark comparisons. Comparing fund performance to benchmarks such as the CRISIL Short-Term Bond Fund Index helps in assessing how well the fund is managed relative to its peers. For example, analyzing the SBI Magnum Gilt Fund, which primarily invests in government securities, shows a stable returns with low credit risk, often outperforming its gilt fund benchmark during periods of falling interest rates. The role of fund managers. Impact of management decisions. In debt funds, the fund manager's expertise in selecting the right mix of securities, managing the duration, and adapting to changing credit environments is crucial for maximizing returns and managing risk. Skill evaluation. Assess the experience and track record of the fund managers, particularly their performance during different market cycles and interest rate scenarios. For example, the manager of Franklin India Low Duration Fund has demonstrated skill in managing a portfolio through volatile interest rate conditions, delivering consistent returns above its category average. The fee structure and cost really influence the returns available for the mutual fund investors. So let us try to understand the issues relating to fee structure and cost. Expense ratios. Understanding the expense ratio of debt mutual funds is essential as it directly impacts the returns. Compare this ratio across similar funds to ensure you are not overpaying. Cost versus benefit analysis. While lower fees are preferable, weigh them against the benefits provided, such as fund performance, services offered, and management quality. For example, comparing the expense ratios of the Kotak Bonds short-term fund and other short-term debt funds can reveal cost efficiencies that contribute to better net returns for investors. Now let us understand how the mutual fund firms are managing the risk of debt funds. Credit risk. Credit risk refers to the risk of default on debt that may lead to financial loss. Higher credit risk are associated with higher returns but increased chances of default. Interest rate risk. Interest rate risk is the risk of changes in bond prices due to varying interest rates. Funds with longer maturities typically face higher interest rate risk. For example, the Aditya Birla Sun Life Corporation Bond Fund manages credit risk by investing predominantly in high-rated securities, mitigating potential defaults while providing competitive returns. What are the tax implications for investors? Tax on interest. Interest income from debt mutual funds is taxed according to investors' income tax slab rates unless held for more than 3 years. Indexation benefits. For debt funds held for longer than 3 years, the gains are taxed at 20% after indexation, which can significantly reduce the tax burden due to inflation adjustment. For example, an investor in the 30% tax bracket could benefit from holding the Axis Gilt Fund for over 3 years, utilizing indexation benefits to reduce taxable gains. Now let us understand the importance of investor sentiments and ratings. Importance of investor reviews. Reviews and ratings from existing investors can provide insight into fund's performance, fund house responsiveness, and overall satisfaction levels. Interpreting ratings. High returns often indicate good fund management and satisfaction with returns, making them a valuable tool for assessing potential investment options. For example, before investing, a person reviews investor feedback on the Nippon India Liquid Fund on platforms like Value Research Online, noting high satisfaction rates, particularly for customer surveys and consistent returns. Market timing and investment strategies. Optimal entry points. Timing your entry into debt funds can influence returns, especially in volatile interest rate environments. Strategies like SIP, Systematic Investment Plan, can mitigate timing risk. Strategic investment approaches. Using approaches like SIP for regular investments or lump sum investments during periods of high interest rates can optimize returns. For example, an investor uses SIP in the HDFC Dynamic Bond Fund to take advantage of rupee cost averaging, smoothing out entry points during fluctuating interest rate cycles. Long-term benefits of debt mutual funds. Compounding advantage. The power of compounding debt in mutual funds can significantly enhance returns over a long period, especially when reinvested. Stability and predictability. Debt funds offer more stability and predictability of returns than equity funds, making them an essential part of diversified investment portfolio. For example, regular investments in the IDFC bond fund medium-term plan have compounded more than 10 years, yielding substantial growth due to the stability and predictable nature of returns. Thank you for joining us on this journey through the realm of debt mutual funds in India. With the insights from today's video, you are better equipped to make informed decisions about investment in debt funds. Remember, understanding your financial goals, assessing fund features, and carefully considering market conditions are key to successful investment in debt funds. Happy investing.